Ever wondered how you could have gotten in on the ground floor of the next huge, game-changing company? Well, that's exactly what we're talking about today, IPOs. So what exactly is an IPO? It stands for Initial Public Offering. Think of it as a company's big debut on the public stage. A private company decides to sell its shares to the public for the very first time. This is a huge step that allows them to raise a ton of capital and gives regular investors like us a chance to own a piece of the company right from the start. But why would a company want to go public in the first place? The main reason is to raise money. They might need funds to expand their operations, develop new products, or pay off existing debt. Going public also massively boosts their brand visibility and credibility. Suddenly, they're in the headlines and on everyone's radar. Plus, it's a way for early investors and the original founders to finally cash in on their hard work and investment. Now let's talk about pricing. How is that initial price decided? The company works with investment banks, called underwriters, to figure out a fair price. They look at the company's valuation, market conditions, and investor demand. But here's the tricky part. Once the stock hits the open market on an exchange like the New York Stock Exchange or NASDAQ, the price can shoot up or drop down based on public trading. So how can you, as an investor, get your hands on these IPO shares? One way is through brokerage firms that offer their clients access to IPOs. But be aware, sometimes these are reserved for high net worth or institutional investors first. For most of us, the easiest way is to buy the stock through our online trading platform as soon as it starts trading publicly on the exchange. Before you even think about investing, there are some key documents you absolutely must review. The most important one is the prospectus. This document is a deep dive into the company's financials, potential risks, and their plans for growth. You should also scrutinize their business model, understand how they make money, and look into the experience of their management team. Who's running the ship, and what makes them stand out from their competitors. Of course, IPO investing isn't without its risks. In fact, it can be pretty wild. One of the biggest risks is high volatility. Prices can swing dramatically in the days and weeks after an IPO. Since the company is new to the public market, there's very little historical data to go on, making it hard to predict performance. And let's not forget the hype. Sometimes a company gets so much buzz that its stock becomes overvalued right out of the gate, setting it up for a potential fall. But with great risk can come great reward. The biggest benefit is getting in early on a potentially fast-growing company. If you pick the right one, the returns can be substantial, both in the short and long term. Investing in IPOs can also be a great way to diversify your portfolio with new and exciting industries. You might hear the term lockup period thrown around. This is a set period of time, usually 90 to 180 days, where company insiders and early investors are not allowed to sell their shares. When this period ends, there can be a flood of new shares hitting the market, which can cause the stock price to drop. It's something to keep an eye on. It's important to understand the difference between investing in an IPO and investing in the secondary market. IPO investing is getting in right at the beginning. Secondary market investing is buying and selling shares that are already trading publicly. So, if you're a first-time IPO investor, here are a few tips. First, don't just jump on the bandwagon because of hype. Do your own homework. Really dig into the company's fundamentals. Start with a small investment to manage your risk, and try to think long-term instead of chasing a quick flip. Is IPO investing right for you? It's best suited for investors who have a good understanding of market risks and aren't afraid of a little volatility. It requires patience, a lot of research, and a clear investment strategy. It's not a get-rich-quick scheme, but a strategic way to potentially tap into the growth of tomorrow's leading companies. Thanks for watching. If you found this helpful, be sure to like, subscribe, and hit that notification bell so you don't miss our next video. See you next time.